There is a standard piece of financial advice that has been handed down like holy scripture for generations. It goes something like this. When you are young, take risks in the stock market. But as you get older, you need to sell your stocks, run for cover, and put your money into super safe bank accounts or government bonds. The logic seems bulletproof on the surface. When you are elderly and living on a fixed income, you can't afford to let a market crash wipe out your life savings. You need stability. But today, we are completely flipping the script on that traditional advice. We are exposing a brutal truth that the banking system rarely mentions to retirees. Moving all of your money into safe accounts is actually one of the riskiest moves you can make. It is a slow, silent financial trap that erodes your purchasing power and guarantees that you will get poorer every single year you are alive. We are breaking down exactly why the stock market isn't just a playground for the young and reckless, but is actually the single best weapon the elderly have to protect and grow their wealth. To make sure you get the maximum value out of this perspective, stick with me until the very final minute of this video. I'm going to share a highly contrarian concept that the smartest wealth managers use to prevent their older clients from running out of money. It goes completely against the grain of typical retirement planning, and understanding it will give you the confidence to let your capital work for you without losing sleep during market swings. To see why the traditional advice is so flawed, you have to look at the massive shift in human longevity. Back when these retirement rules were written, people didn't live very long after they stopped working. If you retired at 65 and only lived until 70, keeping your money in a local bank account making 1 or 2% interest was perfectly fine. Your horizon was short, but today retirement can easily last 20, 25, or even 30 years. If you take a large pile of cash and let it sit in a low-yield account for a quarter of a century, you are making a massive bet against the power of inflation. Inflation is the quiet thief that makes a dollar today worth 40 cents a couple of decades from now. If your money isn't growing at a rate that outpaces inflation, you aren't protecting your wealth, you are actively subsidizing its destruction. This is where the stock market becomes an absolute necessity, rather than a luxury or a gamble. Stocks represent ownership in real businesses. When the prices of groceries, healthcare, and energy go up due to inflation, the companies that sell those goods and services raise their prices. Their revenues increase, their profits grow, and their stock values rise. By owning a piece of those companies, your net worth possesses a natural built-in shield against the rising cost of living. The traditional financial industry loves to sell the idea of total safety because it plays directly into our deepest human fear, the fear of losing what we have worked an entire lifetime to build. They know that a 68-year-old is highly sensitive to seeing a red number on a screen, so they sell products like fixed deposits and low-yield annuities that promise zero volatility, but they conveniently leave out the fact that by eliminating short-term volatility, they are locking you into long-term wealth destruction. You are trading the temporary, uncomfortable roller coaster of the stock market for a guaranteed slow-motion train wreck where your money buys less and less with each passing year. If this direct, unfiltered take on retirement math and the banking system is opening up a new way for you to look at capital, consider joining our community by subscribing to the channel. We don't preach the standard fear-based advice here. We look at the actual mechanics of the economy to make sure you are building a fortress around your wealth that can survive for decades. Tap that button to start treating your money with strategy instead of emotion. Now let's look at how the elderly can safely harness the power of the market without gambling. The key to understanding stocks in your later years is shifting your focus entirely. When you are in your 30s, you are looking for massive growth. You are trying to find the next big technology company that is going to double or triple in value. You are playing offense. But when you are in your 60s, 70s, and beyond, your strategy shifts to a brilliant, impenetrable defense. You aren't looking for the fastest horse in the race. You are looking for the most reliable workhorse. This means ignoring the loud, flashing lights of tech startups and hyper-hyped media darlings. Instead, you focus on high-quality, dividend-paying companies that provide the essential infrastructure of daily life. Think about massive telecommunications networks, power utilities, consumer staple giants that make the toothpaste and soap people buy, regardless of how the economy is doing, and established healthcare corporations. These aren't exciting businesses. They rarely make the front page of financial magazines, but they possess massive, unshakable economic moats. Most importantly, they do something incredibly beautiful for an older investor. They pay you cash just for owning them. Dividends are the ultimate secret weapon for the elderly. When you invest in a basket of mature, highly profitable companies, they share a portion of their profits with you every quarter in the form of cash dividends. You don't have to sell your shares to get that money. The golden goose stays alive in your account, and it simply drops golden eggs into your lap every few months. This completely eliminates the biggest fear of retirement investing, being forced to sell your stocks at a loss during a temporary market downturn just to pay your bills. If you are living off the steady, predictable cash dividends that these companies produce, you can ignore the daily fluctuations of the stock market entirely. If the market drops 20% tomorrow, it doesn't matter, because people are still paying their electric bills and buying groceries, and those companies are still sending you your dividend checks. Furthermore, retired individuals possess a hidden superpower that younger investors rarely have: massive amounts of time and deep perspective. When you are young and working a high-stress job, you don't have the hours required to read, research, and truly understand what you are putting your money into. You are prone to making emotional, impulsive decisions based on what you see on social media. But retirement brings the gift of time. You have the bandwidth to treat investing as a fulfilling, intellectual pursuit. To successfully execute this strategy and turn the stock market into your personal inflation-proof pension, you have to actively reprogram how you react to financial news. The media makes its money by keeping you in a state of constant high-alert panic. They want you to believe that every normal market dip is the end of the global economy. The first shift in your mindset must be to stop viewing stock prices as the actual value of your wealth. A chart on a computer screen is simply a reflection of what a crowd of panicked people are willing to pay for a company on any given Tuesday. The true value of your investment lies in the cold, hard cash flow that those businesses generate. If you focus on building a rising stream of dividend income rather than obsessing over the daily balance of your brokerage account, you will find a level of peace that most retail investors never achieve. Secondly, you need to practice extreme simplicity. You don't need a complex portfolio of dozens of individual stocks to make this work. In fact, many of the world's most successful elderly investors, including the legendary Warren Buffett, advocate for putting money into low-cost index funds that simply track the largest, most profitable companies in the country. Now, as I promised you at the very beginning of this video, here is that contrarian mental trigger that elite wealth managers use to keep their older clients from running out of money. That single word is glide path. Most people assume that as you age, your exposure to stocks should go down in a straight line. But top-tier research shows that the most successful retirees actually use a rising equity glide path. They start their retirement with a higher amount of cash to cover their immediate needs, and then they slowly increase their percentage in high-quality stocks over time. This counterintuitive strategy ensures that as life goes on, their money grows faster to combat the compounding effects of inflation and rising healthcare costs. Take a hard look at where your capital is resting today. Is it sitting in a safe account that is quietly being drained by the invisible tax of inflation? Or is it planted in the fertile ground of real, productive businesses? Be honest with yourself about your strategy. If you appreciate this direct, logic-based approach to protecting your hard-earned wealth, show support by tapping that like button. It helps get this message in front of other thinkers who are tired of the fear-mongering advice. Write the word glide path in the comments if you are committed to letting your wealth grow predictably this year, and I will see you in the next breakdown.